Okay. Yes. Oh, okay. So, portfolio analysis, this was basically how to properly construct an investment portfolio. Because investment portfolio, they brainwash us, consists of stocks and bonds like nothing else in the world. But a properly properly constructed investment portfolio should include cash as much as a quarter, should include real estate as much as a quarter to a third, should include, of course, stocks. Nothing wrong having stocks, but not 50%, not 90%. That's way too risky. I mean, I've always wondered, how do people sleep at night when 90% of their money is in stocks? And tomorrow morning, like the Greek stock exchange or many other times historically, the stock exchange shuts down. I mean, World War I was certainly almost all European stock exchanges shut down. World War II, again, practically all stock exchanges in Europe, again, shut down completely, even the US stock exchange at one point, I think. Again, how do people sleep when 90% of their money is in stocks? And it can just evaporate like that. Again, and of course, a portfolio should have roughly just about a quarter in gold. So a properly balanced portfolio should have roughly, and I can explain a little bit more, roughly quarter in real estate, quarter in stocks, quarter in cash, and quarter in gold. If you believe that stocks are overvalued, instead of 25%, well, reduce maybe the weight down to 20 or 15, depending on how scared you are. If you believe real estate is overvalued, you reduce the real estate to 25 or 20%, okay? If you believe bonds are overvalued, you reduce or eliminate the bonds altogether. Again, if you believe that gold is overvalued, you reduce its weight. And the opposite. If you believe an asset is undervalued, you raise a little bit from 25, maybe 30, maybe 35. Okay, nothing wrong with that. In other words, you take a balanced portfolio and make minor adjustments on the way up or down, depending what you believe is somewhat overvalued or undervalued relative to each other. So that's on the design. And gold has some astonishing properties unlike any other asset. Well, just like silver, but like all the others. Number one, it is almost practically uncorrelated or even negatively correlated to all the other classes, to stocks and to bonds and to real estate. So if it's uncorrelated or slightly negatively correlated, it acts as a better diversifier. In other words, the key word to portfolio is diversification. When you design the portfolio, the purpose, the goal is to diversify. Diversification means you lower overall risk without lowering significantly or at all your expected return. Okay? Now, gold may not boost your expected return, but if it's uncorrelated or, as number two, negatively correlated to currencies, it will certainly significantly reduce the risk of your overall portfolio. Number three, it's already written, excellent portfolio diversification. Number four, I just already explained, improves risk-return profile. In other words, a little bit of gold or some gold up to 20-25% will reduce overall risk without hurting much your return. Now, up to a certain point, maybe up to 40 or 50%, then gold will become too heavy and will skew the risk back. Again, you don't want to have gold 2 or 5%, doesn't do much, okay? But maybe 50 or 70%, maybe a little bit too risky. Okay, I will get to that at the very end of the presentation. I'll get to exactly that point. Again, scholarly research, professors, they take different stock markets and different bond markets, they crank the numbers and they try to optimize. Some find 5% to be good diversification, others find 10, others find 20. It actually depends on what is the time frame. Depending on where you begin and where you end, you could, meaning the period of analysis, how you choose the beginning and ending, and how wide the period is. Gold would typically, in academic research papers, shows a range between 5 and 20. Now, I'd stick with 25, but that's a different story of personal opinion. Now, academics, okay. Oh, academic, that's very easy. Gold is no riskier than stocks. For some reason, people believe that somehow gold is a lot more risky than stocks. Most certainly not. You can take a Dow Jones company and you see how it fluctuates, and gold's fluctuation is no bigger, no larger. You can take another Dow Jones. Well, you compare it to a NASDAQ company, which are a lot more volatile. Gold is just about the same or less volatile. So gold is not riskier when you take it standalone, one against another. It's standalone risk against the stock. It's not riskier, but they present it as if it is a lot riskier, but it's not really actually true. Highly correlated with commodities. I already explained that. If most commodities go up in a commodity boom, gold goes with them. If commodities go down, gold goes with them. Therefore, gold is an outstanding diversifier against stocks, bonds, and real estate, but it does not diversify well against commodities. In other words, if you already have commodity investments like lithium, then a little less gold may be appropriate. If you got commodity investment like silver, a little less gold will do the job. If you got like copper investments or possibly uranium investment, in other words, if you got some sort of real commodity type investments, let's say 10%, then gold does not have to be 20 or 25. You can reduce the weight. You take commodities and gold jointly as one part of the portfolio, 1/4. You look at them jointly. Is that clear? Yes. Okay, thank you, thank you. And very important, this is very important, people get very confused. Gold stocks can't replace gold bullion. You need the bullion, you need the gold, preferably in your pocket and somewhere stashed in the jar or in the safe deposit box. When stock markets crash, gold stocks always crash with the stock market. In other words, when the stock market goes down, gold stocks get dragged down with the stock market. Gold stocks don't protect on the crash side. Okay, they're not a very good protection. It's the physical gold. Gold stocks behave more often like stocks rather than like gold. They're not as appropriate. Now, gold stocks may be good for profits. You want to boost your profits? Yeah, you can put 5% of your portfolio in gold stocks, and on the way up, gold can go up, let's say 3 times. Gold stocks will go up 10 times, okay? So you want to boost return, gold stocks are very good, okay? So gold stocks are better for profit, for gain, for return. Gold physical is not meant for profit. It's meant for insurance, for hedge, for protection. If things go wrong, it's the physical matter that holds best of all, possibly except silver. Next. All right, questions on portfolio analysis before I move to number 4. Is the portfolio conceptual idea clear? Yes, please.
In the current situation, how about the investing in oil companies?
Again, you have to always differentiate between oil as a commodity and oil companies. Yes, it is true that most of the times if oil is going up, the oil companies will go up, but it's exactly the same with oil companies as with gold companies. If for some reason oil goes up, but the stock market gets dragged down, the oil companies will get dragged down with it too. In other words, oil companies behave, oil stocks behave a little bit more, let's say 70% like stocks and only 30% like. In other words, they could be very good for return, but not for protection and as a hedge.
Then you have to own your own oil well. Then you have to buy your own oil well.
Well, that's a different story. That's a different story. All right. Let's see other questions on the portfolio part. Portfolio? No? All right. Well, behavioral. What does it mean, behavioral analysis? It's very simple. In investments, you can be successful only if you're doing the opposite of what everyone else is doing, okay? If everyone's buying houses, it means houses are extremely expensive. You can't make money by buying a house when everyone else is buying a house, because the house is already too expensive. Now, if everyone's investing in stocks, stocks are already too expensive. You can't make money when everyone else is making money. In other words, if you want to be a successful investor, if you tell people, hey, should I invest in stocks? If they all tell you that you should, yes, it's a good investment, then you're sure it's a very bad investment. The opposite. When you give them an investment idea and they laugh at you or ridicule you, this means the idea is good. If you tell, hey, I'm thinking of investing in this, and say, no, this is bad, or they say, well, who's investing in this? And they ask you, do you know anybody investing in it? And if you don't know, that's a good investment. When no one is investing in it, it means it is cheap. Okay? This is called contrarian investing. When I hear a bunch of people talking about investing in something, I already know it is a very bad investment, like stocks practically everywhere in the world. Whoa, wait a minute. Which was one of the best stock investments? You want to invest in stocks? I'll tell you which stock market is the best. Guess, any guess, please.
Russia.
Yes, very good, but not the best answer. Yes. Greece. Yes, thank you, because you're all laughing only confirms, and I'm more than sure that Greek stock market is the best. Greek stock market has crashed close to almost about 20 times. As soon as tell about Greek, I'm investing in Greek stocks, you say, you're crazy, right? If people think you're crazy, this means the investment is good. Okay? This is the proper, correct way. Another way of saying is, again, you look, okay, gold is not well understood. In other words, people aren't buying because they don't understand it. And they don't understand it for two reasons. First, it's not in universities. It's not in the textbook. I was explaining that last time. I got the bachelor's and a master's and a PhD in economics without learning anything about gold. I learned everything subsequently after I got my PhD, but I used my analytical and critical skills and study skills for many years now, 16 years now, to learn and understand everything about gold and money proper. Okay, so it's not well understood. If people don't understand it, they usually don't buy it. Everybody understands and is an expert in real estate. I've never seen a guy who says, I don't know and understand. They're all experts and they're all buying. And it's late, too late. Okay, it's like $250,000, $500,000 in Europe, right? in your currency is going to be way over. Can you buy anything for $1 million? Kroner?
Not here.
Not really, not here, not nearby, not anywhere, not in town, okay? Well, that means it's horribly expensive. All right, so next, it is not widely recommended. Now, how many people, yes, please?
Just as a gold, not well understood. You said gold is not well understood as a commodity.
No, it's not well understood as a hedge, as a protection, as a commodity, as money. Mostly governments provide propaganda. Wall Street hates it because Wall Street cannot print and manufacture gold. Correct.
But the way I see gold, I cannot eat it.
Correct.
I cannot pay tax with it.
Correct.
So what is the point?
Can I just summarize the question for recording? So the question is that since I cannot eat gold, I cannot pay taxes with gold, at least under normal circumstances. What is the intrinsic value of gold then?
Is it more than a speculative object? Is my question.
Is gold
Yes,
more than a
of
speculative
course.
object?
Yes, of course. It's no, it's not speculative. It's got true range in it. Again, I explained last time. Remember what I was saying last time? I rely on about 500 million Indian women who want it desperately, and 500 million Indian men who will kill the gold for their women. There's 250,000 billion Arabs who are dying for gold. Please do.
But wait, maybe they have to be more educated.
Please. We
They
have.
cannot eat gold.
They don't.
They cannot
eat-
kill each other.
No, please, let me finish. You cannot possibly ever get married in India without the proper amount of gold. You cannot get married in Thailand without the gold dowry. It's impossible. In China and other places you cannot get. Same thing is or similar as in Cambodia, not exactly. But many cultures, gold is essential in many different places. We're
But now you are
talking,
inventing-
look, please, we are not talking about, let's say, 5 million Europeans brainwashed by governments. We're talking about billions of people. About 3 billion people in the world are still
if I may also
crazy about
But
gold.
if I may also add to this discussion, if we're talking about what is the true value of gold, yes, I cannot eat it, I cannot pay my taxes with it. But I think if you look at it historically, the intrinsic value of gold is a means of an exchange.
Yes, it's a medium of
means of exchange for either goods or services. And historically, if you look at time, if you look across cultures, a gold coin might buy you a fishing boat in China, a whole village in Africa. No racism intended here. But across time, across cultures, it is universally accepted as a means of exchange. And if you're looking to buy gold from a perspective of protecting your assets, protecting your value, then across time, gold is the only thing that has lasted, and all things being equal, is the only thing that will last as a means of exchange, as a means of representing values. Then you can always talk about, well, then yes, at a very, very basic level, we should have some guns, we should have some food. But then we're back to the barter system, and hopefully we're not going to end up there. But the intrinsic value of gold is that it represents value and a means of exchange. And we can always discuss how much you should get for your gold, but you can always get something for gold. And at least from where we're sitting, at least sort of the philosophy of the company that I represent, this is the value, this is the added value that we try to give to our customers.
Well, let's try a very different answer. You're Russia. No one's going to give you, back in the old days, I'm talking sort of about Soviet Union, okay, especially during World War. If Russia's, meaning Soviet Union, wants to get any import, they cannot pay with money or anything else. They gotta pay with gold, okay? Gold is the only accepted payment, okay? World War II, no matter what happens, everything gets paid to America only in gold. Nothing else is accepted except for gold. I mean, we're just talking about, hey, I've been buying quite a bit of, I got a nice, lovely Filipino girlfriend. Oh, I want gold ring. Okay, as soon as we got the little 2-gram gold ring, she wants the gold earrings, and then wants the gold chain, and then wants the gold pendant. They are all like that in the Philippines. They're all like that in Thailand. They're crazy about gold. Nothing else but gold. And it's relatively like that in China for probably half of Chinese, but that's almost 1 billion people. And they're all 1 billion Indians, just like that. And it's similar in Nepal, okay? So again, this is more than half of the world are like that, okay? And just because some people here don't eat it, out there they do. That's how they buy their houses. They pay with gold over there, okay? It happens also in, again, in good chunks of Africa too. That's a different story. African tribes and cultures and whatnot. So yes, maybe 20% of the Western population. But then again, I was just telling the story the other day, Bulgaria. We had a wild and crazy hyperinflation between 1990, after the fall of communism, up until 1997. Well, guess what? As our currency was going through hyperinflation, 3 accepted payments in the whole country, anywhere. Dollars, Deutschmarks, or gold. That's it. This is what you pay with. You know, nobody will accept the Bulgarian currency. And similar situation in Russia and other hyperinflationary stories. During the hyperinflation in Zimbabwe, they stopped accepting Zimbabwean dollars, okay? They'd use American dollars, but because they're mining in some gold and gold nuggets, they do accepted gold. Gold became a means of payment. So yes, very true, 20 or 25% of the world global population, maybe 2 billion, don't take it and accept it, but 5 billion still do, and they want it, and they're eager to get it, okay? So I hope that answers partially the question. And again, right? She wants a whole lot more of it anyway. Anyway, let's try other questions. On, what was it? Okay, still unloved. Yeah, people, there's no passion for gold. People are not passionate. Hey, you can't even convince them, okay? Even after 2 hours of talk, you know, one was convinced, 9 others were not, okay? There's no passion like there is for real estate. There's no passion like there is for cryptocurrencies or stocks, okay? It's on their own. What percentage of people do you think own gold, roughly? Of people, of number of people, not in the room, in general. Let's say of your own population, or Bulgarian population, or Russian population, whatever.
1%.
Yes, between 1 and 2% in the West. Yes, and this is where the bigger money is, like Denmark, like UK, like US. Between 1 and 2%. This means that it's underowned. So all you need from 1%, only 10% of the people to buy, so that demand investment will increase 10 times from 1 to 10. Or if it's from 2 to 10, it will increase 5 times. That's where the potential. Gold is hard to value. CFAs, they use cash flows, discounted cash flow models. They can put in on a stock or a bond, forecast the dividends, forecast the interest payment, the principal, and they can calculate. In gold, they cannot make the calculation because gold doesn't have a cash flow. And then they say, well, they don't know what to do. Well, oil doesn't have a cash flow either. And copper doesn't have a cash flow. Most certainly, rice and wheat don't have a cash flow. Water doesn't have a cash flow, but you know, somehow there's demand, somehow there's supply, and somehow there's value. They're traded, they're valued for them. Just like copper is valued and silver is valued for whatever their purposes and uses are. Okay, so that's what they say, oh, you don't know. So the first argument, you can't eat gold. The second argument, you know, gold has no value. No, it certainly has many values, like jewelry. Please come to the Dubai gold souk. At least go on Google and just look at the pictures.
I've been there.
Oh, thank you. Then you know what I'm talking
I
about.
know.
Close to 1,000 gold shops, okay, with tens of thousands of customers walking each day. All right, let's see what else we got. Undervalued, forgotten after 4 years. Yes, from 2012-13 up until 2015-16, gold went through a correction, so it has been relatively forgotten. Now the excitement is cryptocurrencies and whatever else, but not gold. Now, in this correction, gold has fallen almost 40-some% from $1,920 down to $1,050. Currently it's 1,300 and whatever. So with the correction, it's somewhat cheaper and better value now. And what else we got? Oh, it's not exciting. You know, meaning most people don't get excited like they get excited on real estate or on stocks, and certainly there is no excitement factor like in Bitcoin, where you can get rich quickly. Gold won't make you rich quickly. That will never happen. If you're already rich, gold will help you stay that way. Okay, but there's no, if anyone's promising you're going to get rich in gold, they're lying and cheating and manipulating. It's just as well as you are, you're going to be just as well or slightly better, but not a whole lot better. You know, you need to speculate, but that's a different story. I don't want to get into it. Let's see what else we got.
Yeah, before we,
Yes,
this is the final
great.
one, yeah? So we have approximately 5-6 minutes left.
Okay. Questions on the on this particular questions on the behavioral part? Is it fairly clear? Okay. Well, finally, this technical analysis. Okay, it's in a secular uptrend. It appears that the uptrend will be about 30 years or so. We had the first leg about 11 years. Then we had the intermediate correction, you know, for about 4 or 5 years. And we can expect about 8, 10, 12 more years on the next leg up. Each leg will be up 6-8 times. So from now on, we can expect another 6, 8, or 10 times. So maybe roughly 10 years from now would be roughly 8, 10 times from here. Again, could be 8 times from here, could be 10, could be 12, hard to tell. But again, you'll judge it up against stocks and real estate to see at what time, at what point it gets relatively overvalued, okay? And it's also seasonal and whatnot. Gold always has corrections. Like stocks, like all bonds and other stuff, it goes up and down and up and down and, you know, goes in a zigzag channel fashion, okay? Let's see what else we got here. All right, well, these are some chart. There is a similarity between the behavior of gold in the 1970s, and you see there the 1970s bull game. This would be the yellow one here, and the bull market from 2000 up until 2016. And actually in the 16 it bottomed, it's been going up a little bit, and there is an astonishing similarity between these two. They track each other remarkably well, but the 70s cycle was roughly 12-14 years. This cycle is stretched twice in time. So in this cycle, everything takes about twice longer, both on the way up, in the correction on the way down. In the 70s, the correction was exactly 2 years long. Here, we got a correction of exactly 4 years long. The first leg up was exactly about 4 or 5 years. Here, the first leg up was exactly 10 years. So it seems that the time frame back then to now is just about roughly 2 to 1. And this gives us some idea that based on cyclical and technical analysis, we're going to have roughly another 8, 10, 12 years. You can't nail it, but it's not necessary to nail it perfectly. Just have a reasonable, educated expectation what it might be. Let's see what else we got in here. All right, okay, well, that's the correction I was talking about. The correction, the peak was the European financial crisis somewhere in 2011, and somewhere down in 2015, there has been a bottom of 1,050, and it's been slowly moving up and up and up, and now it's actually broken out of this channel because it's already 1350 today, close to 1400, so it's already just about broken. I mean, I haven't updated this, it's just a few months older. But it overall tells us, well, this 4-year-old correction, it appears to be over, and we got a lot of things happening now that suggest that. Yes?
The valuation of gold is normally calculated in dollars.
No, that's not, oh, sorry. No, not true. The price
Is in dollars.
is quoted in dollars.
Yeah.
The price is just, sticker price is in dollars,
Yeah.
but it doesn't mean that it is valued in
No,
dollars.
that was my
You
point.
can value gold in shirts, you can value gold in oil,
Yeah.
you can value gold in housing. You most certainly, I've been valuing it earlier today in stocks.
Yes, but normally I've been looking at it at when dollars go down, gold goes up.
Correct.
So maybe it's better to compare it over years in Indian currency or
Okay,
China.
yes.
If I could just summarize the question, so if I understand your question correctly, if you compare the dollar rate to the gold price, historically it has been that when the dollar price goes up, gold will go down. Is there a better way to compare the pricing of gold
Because
relative to other currencies?
the demand is not in people who has dollars, the demand is in people who has other currencies. That is my question.
Okay, first of all, the gold price is only quoted
Yes,
by convention. Okay, now, second, the fact that when the dollar is up, gold is down is not true. It
Okay.
is true roughly, exactly about 60% of the time. 60% of the time when the dollar is up, gold is down. When the dollar is down, gold is up. About 40% of the time, they go up in tandem.
Okay.
40% of the time, gold is up and the dollar is up, or gold is down, the dollar is down. So again, gold is an excellent, because of this correlation, this 40% of the time is an excellent diversifier of the dollar too. Not only of all the other currencies, but also of the dollar. So yes, true 60% of the time, but not always, okay? So that's not a genuine long-term relationship.